Zafer Yüksel. I'm an assistant professor of finance here at University of Rhode Island. Overall, finance to me is a big fun puzzle to solve through using math and human psychology. There is a growing demand for people who not only have solid understanding of financial theories, but also solid knowledge about how to use, interpret, manipulate, and visualize data. Over my career, I taught wide variety of classes, but I eventually realized that the existing curriculum is just the surface of this beautiful area in finance. This is when my story starts in University of Rhode Island, and I am interested in the Fintech program. Fintech basically means financial technologies. In these Fintech programs, I developed two classes, financial technologies and data analytics, where we are combining both interesting aspects of finance and developing the finance industry. So based on my experiences, I realized that especially finance students learn more when they actually apply what they learn in the real data. And this data analytics class allows students to obtain the necessary skills, programming skills, visualization skills, and their interpretation skills of financial data. In this webinar, my goal is to take you back in the history, how money is invented, and how it's developed, how it's improved. And I'm going to talk about the current form, how these things are changing now, how blockchains and cryptocurrencies decentralize this system and move money around the world instantly. I am going to do it by making things as simple as possible, because believe me, things are simple, just the buzzword we have to learn and we have to be careful about.
Hello, everyone. My name is Karen LaPointe, and on behalf of the URI Foundation and Alumni Engagement, I'd like to welcome you to our program today. We are very happy to present the first in our Fall Faculty Office Hours series this semester. We are partnering with the College of Business in honor of their 100th anniversary to present a series called The Future of Work. Today, we welcome Zafer Yüksel, Assistant Professor of Finance, who will demystify the world of financial technology. Acting as moderator of the discussion is Dr. Donna Gamache-Griffiths, Associate Teaching Professor in Business Law. She assists in the development of legal courses across undergraduate and graduate programs and oversees the International Business Program, one of the university's signature dual degree programs. A proud alumna of the College of Business, she went on to earn her J.D. at Roger Williams University School of Law and her Ph.D. in Humanities at Salve Regina University. Donna is also a practicing attorney and teaches at our partner schools in Europe. If you have questions for Professor Yüksel, please post them in the Q&A section at the bottom of your screens. We'll do our best to get to as many questions as we can after the presentation. And just a quick note, today's program is being recorded. In a few days, you'll receive an email with a link to the recording, along with recommended resources for further reading. You'll also be receiving a very brief survey from us, and we do welcome your feedback. Now, I'd like to invite Dr. Gamache-Griffiths to join me on screen.
Thank you, Karen. Welcome, everyone. I'm so happy to be here and so glad you could join us today. I'm joined by my colleague, Dr. Zafer Yüksel. Professor Yüksel recently joined the College of Business faculty in URI's new FinTech program. His research interests focus on empirical asset pricing, institutional investors, and mutual funds, with recent projects primarily focused on the market frictions and trading behavior of mutual fund managers. His research has been published in numerous financial journals. He holds a Ph.D. in finance from the University of Arizona, an MBA from California State University, San Bernardino, and a BS in electrical and electronics engineering from Middle East Technical University. And now I'd like to invite Dr. Yüksel to join me on screen.
Thank you, Dr. Gamache-Griffiths, for Here you go. You can hear me right now. I'm so sorry about that. I'm a little bit excited about this. Again, it's a privilege to be with you today. I know we have much to talk, yet somewhat limited time. And I promise I try to be as intuitive as possible and not touch too much technical details. At least I'll try. So let me begin with my roadmap today. We are going to start our journey with fintech. This definition is going to be actually help us because over time, the way we transfer money, capital change quite a bit. So we are going to define the fintech, and this is going to help us to distinguish different terminology, some buzzwords commonly used, sometimes misused in popular media. And of course, today we are going to talk about currency. So it's important to understand definition or what money is actually. And then of course, everybody's excited to hear more about still blockchain, even though price goes down a bit. So I'm going to talk about the characteristics of blockchain. And then I'm going to conclusion. Again, this is my humble takes. I might be wrong. I'm an academician. Most of the time I'm wrong, but this is my opinion and I am trying to answer your question at the end. So let's start with finance and innovation. In history, innovation is always center of the finance. And we start with bartering, which replaced by the gold nuggets replaced by the paper money replaced by checks, etc. One commonality on this finance technology innovation in finance is so far all this innovation spearheaded by financial institutions themselves. At this time, any different? The answer is yes. This time, tech companies leading the change. The reason is they have big data advantage. They are more aggressive in taking risk associated with new products, technologies, and compared to financial institutions, these tech companies are less regulated. So which gives them a flexibility to try new things and new products. So this is the first time traditional financial institutions are in danger of being leapfrogged. So let's define them, like what is fintech, why this is happening. And if you ask this question, what is fintech to 10 people, most likely you're going to get 10 different answers. This is the broadest answer I can give it to you. This is the use of technology to enhance or deliver financial solution. So what is this new financial solution? Again, these new technologies are changing the way money and capital are transferred, raised, and invested. These three areas. So we have this fintech program. We just started URI this year. So these are the three focus points in here. So let me give you an example. When we talk about a full service financial institution, there are three parts: transferring money, which is deposit accounts, maybe payments, money transfer, right? So raising money, credit cards, part of the raising money, or business lending, investment advisor, trading services, wealth management. This is what we see as a traditional full service institution. But what happened here is the challengers pop up. They are not trying to be a full service financial solution, but they are trying to help to payments, for example, PayPal, Venmo. I know you are using this item Square, and Bitcoin and the blockchain is kind of coming here. And other than that, you see raising money, we have peer-to-peer, platform lending, crowdfunding, machine learning, robo-advisors, and everything. So the one important thing you have to remember is the fintech is a broader term. So you see this blockchain is just part of it. And people there's one common misconception is crypto and fintech people use as if they are the same. Of course, crypto and blockchain is part of fintech, but not necessarily these two terms are the same things. And of course, we are going to talk about blockchain, some interesting products, some niche products they are providing. But again, we have to be careful about this distinction. When we talk about fintech, we are talking about a broader transformation, and some fintech areas, especially, let's say, less hype-prone fields like robo-advisor, machine learning, if not equal, they are almost as transformative in financial system as the blockchain. So this is the first part of the conversation. So let's talk about what is money. Through the history, money has been ever-changing concept. We use gold as a money to silver to paper currency, and everything. So let's try to understand what makes money money. I didn't really find a good definition for money, but I find a good functionalities of money. When we talk about money or fiat currency, I'm going to use these terms interchangeably. There are three things. One, money as a unit of account. So basically you can price goods or services. And the medium of exchange, there's some transaction happens using a fiat currency, and store of value. So look at this definition of functionality. I mean, again, my presentation style, even in teaching, is a little bit different. But let me ask a question before I answer at the end. What do you think if I ask you what you hear, what you read about Bitcoin? Do you think it's a money? And I know, like, this is, most of you guys have an idea right now, just looking at this clear definition. But let's move along. And then let's discuss why does, money have value. The reason is the government says so. So basically, government says that this is a legal tender. And historically, China is the first country with paper currency not backed by any precious metals or commodities. In 13th century, China, Kublai Khan, which is grandson of Genghis Khan, he just decreed that the paper currency issued by his court was legal tender. So paper currency had to be accepted as payment for debts, or you die, basically. So as you see, the money is created by an official authority. In this China case is Kublai Khan. In our case, Federal Reserve is usually not backed by anything other than faith, except for a couple of, Hong Kong dollars are backed 1-for-1 with US dollars. Bulgarian lev is fully backed by euros. And the other than faith is central bank or government that stands behind it. And again, the key here is the trust is the imperative for this economic system to thrive. And when you hold $1 bill, it represents the trust to federal government and the economic system as well. And then what happened, for example, after Kublai Khan introduced the currency, the successors issued a lot of money to finance war. Hyperinflation begins, just like in Germany after World War II, and economy collapsed. So let's see how this works, and let's look at an example together. How trust to government and financial intermediaries play a role, central role in this in money. Let's have a cup of coffee together and paid with cash. So as you see, we have a customer. This is me, maybe, and he's a merchant here. Of course, I don't know him. He doesn't know, the merchant doesn't know the customer. It really doesn't matter because cash transaction make unnecessary for parties to trust each other. Instead, both parties place their confidence in the government and or central bank that issued the currency. If you use US dollar, you are trusting the board of governors, Federal Reserve, which the group of political appointees actually. And as you see, things are a little, sensitive, like, last Trump administration is a little bit different than the today administrator. So things can change drastically, unfortunately. And so you are trusting them not to print too much dollar. And overall, Federal Reserve actually, this job reasonably well. We cannot say for all other central banks around the United States, historically, all central banks fail. Hopefully, cross the fingers, Federal Reserve is not going to fail in my lifetime, but things might happen, right? So let's make the things a little bit more complicated. Let's pay this transaction with the credit card.
of course, this time the absence of trust between customer and business is overcome by pretty much the banks, the system like the Visa transaction system. And as you see, once again, the background change, but the trust in the payment system still imperative for the smooth functioning of a modern economy. And of course, this trust is not necessarily free. As you see, there is some fees going on here and there. And of course, you see fintech companies try to make things either faster or cheaper or more secure for customer or merchants, right? So this is how fintech's infusing into the financial system. The other thing here is actually Visa system is an absolutely marvelous system. It's very efficient. Visa can handle 65,000 transactions per second. Quite efficient, convenient. Of course, this convenience, as I mentioned, comes with the cost. But so what happened? Why do these disruptors, these new tech firms come and try to, change this financial intermediation? Let's look at a little bit history here, because there is some loss in trust happened during the global financial crisis of 2007 and 2008. I'm not going to go in detail what happened, but the bottom line is the meltdown of US financial system at that time seemed imminent, and Federal Reserve, the bank who issues money, which we rely on, we trust on, expand its balance sheet, so by purchasing US government bonds, other financial assets, so issuing money. They spend money for saving the financial institutions, banks, right? The deficit goes up to $5 trillion during that period. And on one hand, again, US spent $500 billion bailout to save the financial system. Big banks, this is one critic of the failure. On the other hand, people like us lost their jobs, their savings. We are in this hardship, right? So the time was kind of a very nice, because the financial institutions were all shaky enough to provide, I should say, fertile ground for the new alternatives to emerge. And this is what popped up in web is in the fall of 2008, barely 6 weeks after Lehman Brothers declared bankruptcy, Satoshi Nakamoto, and still nobody knows who that person is, write a white paper, they call it. This is just a technical document explaining how this Bitcoin or blockchain system works. But his blogs basically states the lack of trust, the shaky trust in the government, the centralized system, this apparent in his blog, actually. So let's move on and let's talk about blockchain then. What is this blockchain? What is this Satoshi Nakamoto guy talk about when I say blockchain? So blockchain is just a software protocol. So basically, just step back here. Blockchains are nothing but software protocols. So basically, you don't have to trust the central government or any authority. You start trusting the algorithms and math, right? Just be in the same page. So this protocols allow multiple parties to operate under shared assumptions. So we are using the same algorithms, same assumptions in these algorithms, and data without trusting each other. So I don't have to trust anyone because this system is going to create a trust, which I'm going to explain in a minute. This data can be anything. These are the transaction data. I send you money, that you send me money, or like, healthcare, any public record, real estate. So basically, it's pretty much a decentralized record keeping system. I'm underlining is decentralized. And this package or information add to the blocks, add to the data sets in blocks, chained together cryptographically, so you can audit it really nicely and in a quick way. And there is some sort of a consensus mechanism because everybody at the end has to have the same unified record. And optionally, again, it's optional, they might have coins or tokens to facilitate the value transfer. And again, since Bitcoin is the first, I'm going to talk about Bitcoin, not all alternative coins at this stage, but once you see the big picture, the idea, the all other systems or coins or blockchain systems are going to be somewhat share the similarities. And for example, in this example, the difference between this Bitcoin and Ethereum, of course, you most likely heard both of them. The differences are just the type of data you can upload in the blockchain. The Bitcoin is just transaction data most of the time. Ethereum is like a little bit more programs you can upload the data. So the consensus reached between parties, like basically to create this unified record. So in order to understand this decentralized system, let's go back to centralized system. Centralized system may be Facebook, Dropbox, you have some user application, you generate data. It really doesn't matter what this data is. This data goes to a database server. This database service receives the data, process the data, and store it. But the thing is that the reason we call it centralized because Facebook has this server, Dropbox has server, Gmail has this server, Amazon has this server, is already somebody's taking care of. So they can change the data, right? This is one thing about the centralized system. And this database somewhat stored on server, some unique data format. So basically, at the end, you can get the data, whichever data you upload very quickly. In our case, story starts the same. We have some application, something, we generate some data in Bitcoin, some transaction maybe, but this time it doesn't go to a central location. It goes what we call peer-to-peer network. So these peer-to-peer networks, you can call them people, nodes, miners, validators. I'm going to use these terms interchangeably. Of course, there are some differences, but for our purposes, I'm going to use them as if like same. Just like people like us, let me say. Okay, and then we get this data, validate, oh, this data is correct. Zafer really sending money to, let's say, Donna or Karen, and everybody accept it, and we are including in the database. And this is stored in a chain data format. So basically, my strategy right now here is to describe the system. First, I'm going to talk about client identities. This is the easiest part. That's the reason I start with that. Second is the chain structure, you know, but you can understand why we call this blockchain, how this chain together. And then we are going to talk about how network process data and reach the consensus. This is a little bit more technical, so I let it at the end. Okay. So basically, when you say the identities, let's suppose you want to use the Bitcoin network to send or receive some payments. Any other account, Venmo, PayPal, it really doesn't matter. Register an account. You need to generate an identity, like username, right? Unlike PayPal, though, or Venmo, in Bitcoin, this is a much simpler process, a fraction of a second. So you simply use an app to generate a pair of encryption keys. So these keys are essentially very large numbers, random numbers that are mathematically linked such that other people cannot easily guess one from the other. So both keys used to encrypt data that you generate, basically. You assign one of them as your public key, as like almost your account, you know, information, my bank account, here you go, or my email address, you can email me anything. And the other one, you're gonna keep it, you know, as private keys, as secret as possible. It's my password, right? Because, you know, I can so access it. It doesn't matter which one you pick. The important part of this process is the mathematical link between the keys. The keys are set up such that the data encrypted with your public key can only be decrypted with your private key, and vice versa. So suppose your friend wants to send some Bitcoin to you, then what he or she does is simply generate a transaction data, designate your public key as a receiver, then only you can open it by decrypting with a private key, which only you have, and you'll try to keep it as secret as possible. On the other hand, when you want to send the money to someone else, your private key basically serves as your signature. You are going to generate the transaction data to someone else's public key, and you are going to encrypt it with your private key. So this is a little bit trivial, a little bit pointless, because anyone can decrypt the data with using your public key, which is available to everybody. But that is precisely the ingenious of the system, because any information can be decrypted by your public key, must be encrypted with your private key, which you only have, no one else has. So people can confirm this information or this data is coming from your account. So this is quite a nice way to validate the transactions. And this is the first part. The second part, how data is chained. So basically, it really doesn't matter how large the data, it really doesn't matter. We are going to use what we call hash pointers. Basically, it is a fingerprint of the data. So basically, whatever your input is, any data, transaction, Shakespeare stories, this encryption or this hash algorithm convert this information in 256 binary bits, which is ones or zeros, using 64 digits in hexadecimal format. So 0 to 9, A to F. So basically hashing almost uniquely compress the data in a unique way. It's creating a fingerprint. And this is how it works. We don't have time, I believe, to check this out, but the important characteristics of this one is computationally efficient, deterministic. The output always is the same if you are using the same input. Pre-image resistant, you cannot really guess looking at the hashing to what the information is, and collision resistant. So basically, it is almost impossible to get the same keys and same hashing using different data. So this is so efficient. The possibilities you have is 1.15 10 power of 77, which is 115 quad 2 or vigillions. This is a number. It is so big that the seconds passed since Big Bang is less than this number. So if you want more information, most likely my slides are going to be available to you at some point. You can go read even more about this cryptography twin term. So once you have the key, this fingerprints for the data, you start adding, after you confirm the blocks, you are including the fingerprint of the previous block. So basically everything is linked so efficiently. You have the fingerprint of the previous blocks. So anything you try to change in here is not going to work, because this cryptography is so important. Any small changes has an avalanche effect, is going to make a big change in this hashing algorithm, and anything you change here is not going to match in here. So this is the ingenuity of the block system. And of course, this is the fun part where the coin concept is coming. So we talk about this peer-to-peer network, which basically receives the data, processes the data using consensus. But who are this peer-to-peer network? Once again, these are nothing but people like us. How to incentivize them? How they can create a trust so that every individual from here in the United States, I am, someone in Turkey, someone in China, we don't know each other. How can we trust each other? So this is the how we are going to reconcile the difference. So this is where things are getting more interesting here. So this network use, first of all, called something gossip protocol. So basically transaction propagated to the network slowly, but everybody can get a little bit different transaction because everybody's different location or system latency. And then in Bitcoin, at least, this is what happens: batch processing. Every 10 minutes after the consensus validated, they wait so that the data is everybody has the same data after 10 minutes. So you see, like 10 minutes is a long time compared to Visa. And one catch in the Bitcoin is it is also only 1 megabyte. So it's only 2,000 transactions here, and which makes it 6-7 transactions per second. As you see, it is so inefficient compared to Visa. It's very, very slow, basically. But so far, so good. Everything is good. But once again, we still don't know how people agree which block, which information is correct to add, because everybody wants to add this information. So we need something called proof of work or consensus mechanism. Again, this is Satoshi Nakamoto described this one, and the idea wasn't new actually. This is not invented by Satoshi Nakamoto, but this idea is coming back to 1993 to combat spam emails actually, but not unused. And 1997 actually it's called proof of work, and Satoshi Nakamoto thinks that this is a good way to create a consensus to secure Bitcoin block. So what is it? It is nothing but a hashing puzzle. So basically let me tell you the definition. I'm going to give you an example in a minute. Append a random nonce to block to find a fixed number of leading zeros. So the idea is the puzzle requires investing large amount of resources and show nodes or miners commitment to the truth of the data in the ledger. So let me give you an example, because this is the part I remember when I was first learning this, I had a little bit a hard time. So what I have done here is, I write a data. Hi everyone, welcome to Faculty Officer with Zafer Yüksel. I use SHA-256 hash algorithm, and this is the hash. This is the fingerprint of this information. So what I am trying to do is I am adding a number. This is called nonce, and hashing this information with this number. And as you see, my hash changed drastically. Look at this first 3-4 digit is 9D887, but on the other hand, it was 2A0F. You see, like even one little change makes quite a difference. But again, my idea is try to get some leading zeros here. Let me try one more time. Let me try 2, 3. It didn't work out. 4, 5, 6, and then 74,975. This random number makes this 4 digits 0. So I solved the puzzle. This is it. So this is a website I use, Anders Brown Word. It's a wonderful person. It's a very, very nice resources I'm using for my fintech class to show some implications of this hashing. Please, I also advise you guys to check that out. And this is the puzzle. But again, in this case, I've tried to find 4 leading zeros. And just to show you how difficult it is, again, I have 1.15 10 power of 77 possibilities. The possibility or probability finding valid hash with 4 leading zero is 0.015. But nowadays, the system is working 18 zeros. This is the probability, 0.00002%. So basically, this is really difficult. So you need a little bit better than my computer at home. So, but what is the incentive? Why they are doing, these miners doing this seemingly meaningless hash game to incentive, of course, coin generation. Bitcoin is you are minting coin because if you solve it, you are going to reward it as some Bitcoin. And transaction fees, some transaction also give you some fees. So the economics are very simple here. Your expected reward and transaction fee must be larger than fixed cost and your variable cost. And it's, of course, expected reward and transaction fee is expected Bitcoin price, number of miner, user demand, system congestion, and fixed cost might be hardware, real estate, energy is the variable cost, hardware when we talk about all this ASIC, the system, dedicated mining chips, some of them are obsolete nowadays. There's also nowadays available cloud mining, you are renting an equipment and paying rent basically, etc. Okay? And as a result, much of the mining now done in mining centers. But when we step back, this is really not decentralized anymore, right? People are getting together, almost centralized, and the system is not working the way it's intended. But the other problem is the energy consumption. You can see a lot of news in here, some, especially United States, some dying coal electric generators that we start used by the Bitcoin miners. This is, this news is talking about how miners, moving from China to other countries. And thanks, Karen here, actually they are not inefficient in terms of power usage, but also they are loud, it turns out to be. So you can find a lot of news about this, mining pools. And ironically, again, it is very intensive, very inefficient energy use. So basically, by comparison, the Visa network takes about 1/3, 200 kilowatt hours to process million of transaction. But to put it in another way, it takes about 600 kilowatt hours to process a single Bitcoin transaction. That one transaction alone can power a typical US household for 3 weeks, actually. And this is just an example how a transaction blockchain looks like. As you see, this is a block number here. I just randomly pick. You see, this is the hashing thing, 18 zeros, and there's a nonce to generate these zeros. And that person is unknown, the miner, and he received 6.25 Bitcoin, and which is basically at that time, is March 2022, is almost $268,000. Then the price was $42,000. So then the $1 million question: what determines the Bitcoin price? This is unfortunately, as a finance person, it's hard for me to understand because we look at fundamentals, stocks, bonds, we have some future cash flow expectation, we kind of find the present value, look into fundamentals, and we kind of have an idea about the price, right? But in here, basically, no fundamentals. So then the question is the supply demand. But basically, when you are using the blockchain itself, you are not using, there is no dollar transferred. Here, just a Bitcoin is transferring. So these exchanges are layered above crypto market, almost again like a centralized, like banks, brokerage, etc. All exchanges happening off of the blockchain. And even worse to me that these platforms are less regulated. So basically, you put your faith on the managers of these companies. And people sometimes believe they own Bitcoin, but in reality, they don't. Just this third party told them they hold for them, right? The most famous case is Mt. Gox's bankruptcy case. Hundreds of thousands of Bitcoins disappear. And the other thing is the speculations called speculative asset. And as you see, there is a very recent news. Somebody just put a press release saying that, oh, Walmart is going to accept the altcoin like Litecoin, and suddenly price jumped to 30%. And somebody just dumped this Litecoins before the actual reality hits. So you see, you have to be really careful about the trading alternative coins. And this is what I have done 2 days ago at home. This is some idea about, this is the top panel is the Bitcoin. This is the SP500. And again, SP500 is even not a currency. It is just a, risky stock market, right? And as you see, the daily return is 0.2% in blockchain starting from 2017. And of course, if you buy it like here or there, you lost quite a bit money actually. But the daily standard deviation is almost 4% based on the sample period I used, which is 61% per annum, which is humongous. It is riskier than the stock market. So let me ask you a question again. What do you think after all see this? Do you think is Bitcoin really currency? It is at this stage, it is really not so. It's so extremely volatile. more volatile than the risk stock market. Not many business accept Bitcoin, which is not a reasonable medium of exchange. And the price is volatile, too expensive. Again, you have to use some decimals to sell coffee, and people we know generally not good at decimals. And scalability, I mentioned 7 transactions per second, it is not enough. So this is my takeaway, this is my humble takeaway from all this discussion. 3 takeaways I can give you. Again, this is my humble, I might be wrong at the end, please forgive me. And prospect of existing cryptocurrencies as a currency, I don't see anything happening so far. So the trust is the issue, but these coins carry to some third-party markets, and they are pretty much speculative assets, I guess. I mean, they are not currency for sure. Are they commodity? I don't know. It's really hard. So, you know, and El Salvador actually try an experiment making the Bitcoin as the currency, and they are having some problems. Prospect of blockchain is, on the other hand, is enormous. Medical industry to finance, art, real estate, patents, performance, any assets that are kept on databases can be carried in blockchains. Potential to remake the world's financial market, because banks, what they are doing is keeping my ledger, my information, account information. But if this information is digitalized and immutable, we really need the banks? Yeah, this is what's happened. And even some NASDAQ and the Sydney Stock Exchange try to carry some transaction in block exchange. So at the end, stock transaction is nothing but changing ownership. You can do it using a token, right? So which makes things easier, faster, more transparent in some case. And prospect of digital money, it is enormous as well. Private companies, Alibaba, WeChat, in China especially, China is leading in this digital currency, and China is leading this currency, and they are experimenting, how to do that. And again, there's quite a prospect. Amazon can do that. Facebook tried. Facebook made some mistakes. They kind of compete with the real currency, but they have a potential. Again, they failed, but this doesn't mean that the Pandora box is open now. Things are developing and changing. And national digital currencies, imagine if we have a digital dollar, do I need, again, bank? I just need an account for Federal Reserve because everything digitally saved. So which is important implications for the financial market. So now I would like to invite Dr. Gamache-Griffiths back to answer some of the questions. And let me stop sharing, I guess. Yeah, there you go.
Thank you. Excuse me. Thank you so much. Now we do have a few questions from the audience, and I'd like to remind you that if you'd like to ask a question, please just enter it in the Q&A section on your screen. Okay. All right. So we will start with the first question. Besides currency like Bitcoin, do you see other promising applications of blockchain in technology? Could it improve things like file storage or media streaming?
Of course, actually, when you look at some new fintechs, I mean, I should say they are not fintechs at all, but they are now tech companies. For example, there is a version of Twitter, but it's blockchain. So basically, nobody censors you. And of course, this, sharing musics or anything, like India actually start doing some real estate. They put in the blockchain. Finland, Sweden, they put this information in blockchain. So enormous authentication of artwork, healthcare. I mean, the applications are enormous application, and 100%. There are so many applications in that areas too.
Thank you. Next question. Still don't quite get if the miners are just trying to get the hash.
Can you repeat the question again? Just try to get the hash?
Sure. The question is, the attendee still doesn't quite get if the miners are just trying to get the hash.
So get the hash means is, again, the hash is already there. You put the transaction, you hash them, there's some numbers, right? So now your thing is your block to be included into the blockchain, you have to compete because there are some other miners create their own blocks, they confirm the transactions are correct, everything ready to go. But whose block is going to go into the system? So this is where this hash game competes. So you have to find some sort of game. So you have to put some numbers and you have to find these leading zeros. Is that cash or hash? I know the number. Hash, right? Yes. So they are trying to find this number, and computer basically to find this number. And again, this number can be anything. So they are immediately, as fast as possible, try to find this number, makes this, the nicks in a hash 18 leading 0 or whatever. And then if they win, their block is going to be added in the blockchain, and they rewarded with Bitcoin and some transaction fees. I hope it is clearer a little bit in that case. I'm not sure.
All right, next question. Will digital money replace cash? If so, what is the anticipated timeline?
I mean, this is the thing. I was always wrong in so many things in my life. Now I am open-minded. I thought that the years ago, internet, I thought is just useless, but it turns out to be the most important thing. I thought that I never give up credit cards. It's already so convenient. I am using Android Cash right now, Android Pay. It's going to be 100%, it's going to change. Again, it started already. China is doing it. And most likely United States is going to do it. I cannot give you the timeline, but my guess is, I say 10 years, but it might be, most likely it's going to happen before that.
We won't hold you to that answer. All right, the next questions. It sounds like you think if blockchain technology will succeed, it will do so based on institutional adoption rather than individual adoption. Is that right?
Right now, this is what it seems to be. Blockchain is important, but I mean, even the people creating different coins, or even the Satoshi Nakamoto didn't imagine that Bitcoin is going to be like this, right? I just, at this stage, let me be defensive here. I don't know, because this is going to be YouTube. And I don't know, but at this stage, centralized is the way. Maybe we can start centralized blockchains, and maybe this is going to lead us more decentralized applications later on. But my feeling is centralized blockchains, and then maybe, as I told you, decentralized happens. But at this stage, I don't see any currency, like based on what this information I have right now, as a potential candidate as a digital currency.
Great. Next question. Do you have any concerns that the harsh approach being taken by the U.S. Securities and Exchange Commission, that most cryptocurrencies will be treated as securities, could be chilling to the further development of cryptocurrencies in the United States?
Oh, that is a interesting question. Actually, Donna, you should answer that question more than I do. These legal things are always another mysterious things to me. So you are teaching this in fintech program as legal perspective. Again, they are harsh, but they have to be, because imagine somebody is coming, creating a currency, they claim a currency, and competing as some way the central government. So we just need to, Security Exchange Commission to be smarter, let me say, And they're going to get smarter because this is what Chinese government is doing right now. Instead of fighting them, accepting and finding the solution, because this is the way you cannot run away. And maybe, again, the Bitcoin is going to be a currency, then find a way to collect taxes out of it, right? So this is the things has to be collected. But again, the legal aspect is always little political competency is another issue. This is hard to answer, unfortunately. I don't want to say much about that.
That would be my class, but I'm not gonna go in there because there's more questions to answer. The next one, is it possible that we will use the same systems, Visa, for example, but they will run on a different protocol or ledger?
Visa system in a ledger. I mean, that is possible. Again, this is basically Visa is also trying to do that, right? Like the Swift also trying to do that one. The idea is to be faster. So, I mean, Visa system is really efficient. It's just like Visa, when you say Visa, it's just a texting. Just you send the information, they text the bank, your issuer bank. They said, oh, this guy has a, credit. I approve the transaction. That is it, right? So definitely, again, this is the possibilities. This is where we are going. I mean, this is not possibility anymore. This is where this technology is going, basically. Visa is involved, especially Visa is also involved in the Libra project in Facebook too, because they know they need, this system is coming, basically.
Good. Can you expand on the note you had regarding one ledger for all?
One ledger for all is, again, this is just like a Dropbox, right? But the problem is we need to have the transaction. Everybody has to see the same transaction at the same time, because at the end I have to confirm that you really I am sending money to you or not, or I have enough money or not, right? So everybody at the end has to have one ledger, right? So basically the updating ledger is this competitions. Only one person update the ledger, but at the end, that's the reason you need 10 minutes. So this one unified ledger, every miner across the network had one unified ledger. So this is a unique idea. The beauty of this idea, nobody can change it. No, it's there forever, as long as you have electricity and, of course, the internet, right? So this is what we called one ledger for all.
All right, I think this one will be our last question. Oh, another one came in. We'll see if we have time. If your guesstimate is right, and we have a cashless society within the next 10 years, what do you think the impact will be on those at the lower end of the income scale? Any thoughts on the bill in Congress called Payment Choice Act of 2022 that is designed to protect those at the lower end of the socioeconomic spectrum?
And this is a good question. Again, a legal issue. However, blockchain, I totally understand. In the United States, especially, things are way better than the other countries. Actually, last class on Monday, I discussed this issue with my students. And PESA system in South America, as long as you have some sort of texting, phone services, we need some basic, tools to use the blockchain. Still, it is manageable. This system can be used very efficiently. Is this the answer? I hope, once again, you are right. We need a minimum system requirements. And I feel like United States, of course, we have some underprivileged families, underprivileged people. But if China, Kenya, and other countries are able to do that, we in the United States can do that as well. And this is actually a good thing for this underprivileged part, because I promise you the transaction fees is going to be quite low, because the transaction fees most of the time kill this underprivileged families, most of the time. So I guess that's my answer.
Good. All right, this will be our last question for today because we are coming up on time. There are many different types of blockchain currency. I have a hard time reconciling how crypto fits in. Right now, we have one currency, the dollar. Would a transition to crypto mean we would be using a new currency or multiple currencies even? Do you think the government will eventually have to choose one cryptocurrency?
I mean, government is not gonna pretty much pick any currency at this stage, I believe, because governments, I mean, again, there are so many cryptocurrencies. The logic is same. Some are faster, some are cheaper, some of the, this is just the software protocols. The thing is whether people trust them as a currency or not. This is another issue. So if you start suddenly, we wake up tomorrow and everybody starts using Bitcoin. Let's assume we trust the Bitcoin, just like we trust in dollar. This is the currency. So the market is gonna pick the currency. United States decide to start their e-dollar, for example, digital dollar, or just like El Salvador, suddenly somebody said that, what, forget about dollar, let's use. Of course, this is very unlikely, but there's possibility. But I'm not sure how they pick, but the criteria, again, this is unlikely to me. But e-dollar or crypto dollar more likely to me than U.S. government, Federal Reserve pick, random currency from this. How many? I have 10,000 cryptocurrencies right now, maybe more, maybe less, depending on the market. So it is hard to see at this stage.
All right. Thank you, Dr. Yüksel, and thanks to all of you for joining us today. As mentioned previously, within the next few days, you will receive an email with a link to today's recording, along with a few of our recommendations for further reading and listening.
Again, faculty office hour will be back on November 2nd, featuring by my colleagues, Professor Doug Hales and Koray Özpolat. We will discuss the future of global supply chains, and stay tuned. Thank you again and enjoy the rest of the day.